The Economic Update with Tatiana Bailey.
New data shows unemployment rates are rising across the country, hitting a four-year high in November.
Dr. Tatiana Bailey breaks down the current job market and how it will impact the Federal Reserve's rate cuts.
Major economic data points are now trickling in, and one of the most important relates to the jobs market. The recent employment report showed modest job growth in November of 64,000 jobs, which is significantly lower than the pre-pandemic historical monthly payroll increase of 190,000 jobs. October's data was stark, showing a substantial payrolls decline of 105,000 jobs. The lackluster job growth was partially by federal employment changes. But if we exclude those distortions, job growth over the last 2 months was only 57,000 jobs. Downward revisions to September's data brings the 3-month average job growth to roughly 22,000 per month. The unemployment rate climbed to 4.6% in November, its highest level since the end of the pandemic. While there was noise in that data, this higher unemployment rate aligns with other indicators such as continuing unemployment claims, the low quits rate, and the moderate but increasing layoffs rate. Consumer surveys reflect that the average U.S. worker is aware of the softening labor market. Young entry-level workers ages 20 to 24 are particularly challenged with an 8.3% unemployment rate. Another important dimension is the softening of wage growth. Year-over-year average hourly earnings growth slowed to 3.5%, the weakest pace since 2021. I break with mainstream economists on the issue of wage growth, as I do not believe the historical approach of examining year-over-year wage growth is applicable now. Most people hear of a 3.5% increase in average wages, and they juxtapose that to the 3% inflation rate and think workers are coming out ahead. This is incorrect because we have a somewhat unprecedented dynamic in the surging of prices during and after the pandemic, leaving us with cumulative broad-based price increases roughly 20 to 30% higher. Such price increases significantly erode single-digit wage increases. A weaker labor market likely means the Federal Reserve will implement 2.25% rate cuts in the first half of 2026. To me, this labor market report highlights that we are in a new normal. In past economic cycles, a 4.6% unemployment rate wouldn't be so bad. But that rate is so low now, mostly because we have fewer working-age people. As such, the recent report highlights we are indeed in a softer labor market.